Hello and welcome to today's short lecture. This is an introduction to lease financing for healthcare organizations. Lease financing is a viable and beneficial option for healthcare organizations that need access to capital without incurring the high costs associated with other loan options. It can be used for buying or purchasing or upgrading medical equipment, technology, vehicles, property, and other assets, providing essential funds without taking on significant debt. Understanding how lease financing works and its implications can help healthcare organizations, the leadership of the organizations, and the financial managers to take informed decisions about their finances and about their investments. So, first of all, what does lease mean? A lease is a legal agreement in which a lessor, which is the owner of an asset or a property, agrees to allow a lessee, and a lessee is the person renting the property, to use the property for a specific period, and this is going to be done usually in exchange for rent or other considerations. So the terms of the lease, such as the length of the rental period, the amount of rent, and the responsibilities of each party are typically outlined in a written contract. Leases can be used for a variety of properties, including technology, including equipment, including buildings, etc. Organizations generally own fixed assets, but it is the use of the buildings or the equipment that is important to the business, not their ownership. So, one way to obtain the use of capital assets is actually to raise debt or equity capital and then buy the assets. An alternative way to obtain the use of capital assets is to lease them. There are two parties to lease transaction. We have the lessee, and it's going to be the party that uses the asset and makes the lease payments. And we have the lessor who owns the asset and receives the rental or the lease payments. You have to notice that the lease decision is going to be a financing decision for the lessee, but it's an investment decision for the lessor. So, healthcare organizations are generally going to be considered as lessees. The healthcare organization, the hospital, are going to be generally the lessee. They will rent or they will lease equipment or other assets to use them for their operations. For healthcare organizations, generally we can say that the lease decision is a financing decision, again, because the organization here is a lessee. It is, of course, very important to understand that lease financing is an important type of financing that allows the organization to acquire equipment or real estate by paying a series of lease payments over a specified period of time rather than paying for the asset in full upfront before actually starting to use it. The lessor typically is going to be a bank or another financial institution, owns the asset and leases it to the healthcare organization. At the end of the lease term, the healthcare organization might have the option to purchase the asset for a predetermined price, actually established when they sign the initial contract. Lease financing can be a useful option actually for healthcare organizations as it allows them to acquire equipment, to acquire technological solutions or real estate without spending large chunks of money, large amounts of capital, and start using that equipment, start using the building, etc., before they completely pay for it. So it also allows them to take advantage of tax benefits in certain cases. There are, of course, some primary lease types. We have operating leases. These are going to be generally short term. They are going to be cancelable. You can cancel the contract and you can also receive maintenance from the owner. Okay, so maintenance is going to be included And the owner, because it's a short term lease, they are going to be interested in keeping the equipment, for example, running and working correctly. If it's long term, this is going to be generally under the umbrella of finance leases. So, finance leases are going to be generally longer term and they are non cancelable. You cannot cancel on a lease contract that lasts for 2, 3, 4 years. Generally, you cannot, after it starts, you cannot say, I want to cancel this contract. It does not include maintenance because generally, after that long period of time, the equipment is not going to be for use for the initial owner, and it's going to be the role of the lessee to maintain the equipment or to maintain the technology, etc. And generally, we can say also that sale and leaseback is a special type of financed lease. There are other types or third types of leases, and these are going to be combination leases that are a little bit more special, and we are not going to be entering into details of combination leases. Tax effects for not for profit businesses, it's an important thing to bring up here. So a tax exempt lease is a type of lease in which the implied interest payment is non taxable to the lessor. So the rationale here, the logic here is that interest payments received by lenders to not for profit businesses is non taxable. Lessors can actually set lower lease payments and still earn their target after tax return. So, not for profit businesses have access to the tax exempt debt market. Okay, so for the balance sheet effects and for financial accounting purposes, and under the new accounting standards update for the United States and also for elsewhere, any lease lasting more than a year must be capitalized by reporting it on the balance sheet as a lease liability and a right of use asset. Leasing is a substitute or an alternative for debt financing. It obligates the lessee to fixed payments. The lessors have rights like lenders, and as such, we can say that leasing uses up a business's debt capacity. Lease financing is an alternative, yet quite different from debt financing, because in a lease, an organization asset is given on a rent basis. On the other hand, debt financing money is involved as credit and earns interest within the time of repayment. Therefore, both are associated with lending, but the properties are being lent are different. There are, of course, lots of motivations for leasing. There are some rational, logical motivations for leasing, like the ability to bear obsolescence, like the ability to bear utilization risk, and the ability to bear project life risk. And also, we have the tax differentials as another rational motivation for leasing. In addition, we can state that maintenance services, lower information costs, and lower risk in bankruptcy are going to be motivating healthcare organizations to obtain leasing, and this is again another type of rational motivation. There are some questionable motivations for leasing that are not as good. For example, leasing preserves the liquidity of the business. By leasing, a business is avoiding basically using cash to make the initial outlay required to purchase the asset. But it's questionable because borrowing and buying also enables a business to avoid using cash to buy the asset because the loan amount is used to make the purchase. Hence, we can say it also preserves liquidity. So the lessees must compare the costs and benefits of leasing the asset to the costs and benefits of actually purchasing and owning the asset. Because the cash flows in a lease analysis are known with very good level of certainty, the appropriate discount rate is the lessee's after tax cost of debt. Leasing is also motivated by differentials between lessees and lessors, such as the rates of taxation. Thank you for attending today's lecture. If you have any questions or any remarks or any requests, feel free to comment below. Thanks again. carpe diem.